So we're starting a new topic called marginal and absorption costing. It's a very important topic. So the topic highlights here, you're supposed to know one, income statement under marginal costing, and two, under absorption costing. That is number one. Number two, you're supposed to know what we call the CVP, application of marginal costing. What we call application of marginal costing. And one here, it is what we call the CVP analysis or break-even analysis. And number two, you're supposed to know what we call non-routine decisions. So these are the topic highlights. Those are the things that you need to know under this topic. This is also a topic that is tested in every sitting. It's a topic that also features in almost every sitting. So it's a very important topic. So those are the things that you need to know. I have shared the notes. I hope if you are one of our students, you must be belonging to one of the groups. If you don't belong to either of the groups after the class today, I'll share my contacts, and then you can also let me know that you are not in any of the groups. Then we join in the group so that you can be receiving notes. Now we go straight away to the notes, which I want to imagine most of us have them. So there it is what we call marginal stroke direct stroke variable costing. So the first one is called marginal stroke direct stroke variable costing. It is a technique of presenting costing information whereby only variable manufacturing costs are considered the manufacturing cost. So when you're producing the production statement or the manufacturing statement, you only consider production cost to be composed of the marginal cost only, or variable production cost. Marginal means variable. So you only take those variable costs to be the constituent of your production cost. That is what you call marginal. So the production cost is only composed of variable production cost or marginal cost. So the fixed costs are therefore treated as the periodic cost, and they are written in the income statement in the period in which they are incurred. This does not comply with the accounting rules, i.e. the International Accounting Standard and the National Financial Reporting Standards. So marginal costing is used to prepare the reports that are used internally. In the marginal costing, the opening and closing stock is valued on the basis of variable manufacturing cost. So now, key features of marginal costing is that it only considers variable manufacturing cost, variable production of manufacturing cost to be the only cost, production cost. It excludes the fixed cost. Another thing under marginal costing is that the reports are used for internal decision making, not for external consumption. So the reports are only for internal consumption, and then the closing and opening stock are valued based on the variable manufacturing costs. So those are the features of marginal costing. We go to another technique called absorption. Sometimes we call it indirect, stock total, stock full. I'm using the notes, which I believe everybody should be having. So I'm saying it's a technique of presenting financial information whereby the manufacturing cost is a combination of both variable and fixed cost. So now the difference between absorption and marginal is that under absorption, the production cost is a combination of both variable and fixed cost, the production cost. And then the valuation of stocks, either opening or closing, is based on the total cost, that is variable and fixed cost. That is it. And then I have given you the table there between the differences between absorption costing and marginal costing. You will go through them, just what you have been highlighting. For example, the first one, the reports is used by external parties under absorption, and the reports are used by internal parties. So there are those differences between marginal and absorption costing. They are around 7. Then similarities between marginal and absorption costing is that they are both used to determine the profitability of the company, and both reports are used for decision making. So those are the similarities between marginal and absorption costing. Now, I want us to look at the first item under the topic. The first item, which is the income statement. So we want to look at the first item, which is the income statement. There are a number of questions that I've highlighted there, but I want us to start with May 2015 question number 3B. May 2015 question number 3B. So if you have your past papers, you open May 2015 question number 3B. May 2015 question number 3B is our first May 2015 question number 3B. So we're looking at the income statement. That is the first thing, income statement. So we're looking at the income statement. Under income statement here, that is what we are looking at. Income statement, we are starting with May 2015, question number 3B. So the question reads, XYZ Limited has provided the following details for the month of April 2015 in respect of production and sales. So we have been given the sales units, 10,000, production, 12,000, and then cost data per unit of output. Selling price is 1,000 shillings per unit. Direct material cost is 360 shillings. And then we have direct labor is 80 shillings, variable production overheads, and then other costs. We have fixed production overheads. And then we have fixed selling expenses, fixed administrative expenses. Then we have additional information. Number one, variable selling costs are 10% of sales. And then normal production capacity is 11,000 units. So required income statement for the month of ending April 30th April 2015 using marginal costing and absorption costing. Total marks, 12 marks. So they want us to produce income statement. So here we're going to produce income statement. So we write the name of the company XYZ, income statement, for the month of April 2015. Then here you can start with marginal costing. Marginal, can answer marginal, so that the examiner can be able to tell. Then here you can write here shillings and thousands, and here you can write here shillings and thousand. So this question will assist us to know the format. So we're going to use the question to lay out the format. So the format we're going to be using, and we are going to learn how to make the statement under marginal costing. So we'll take the sales value. We take the sales value. So the sales value, they produced 10,000 units and they sold, production was 12,000 units and they sold 10,000 units. So it is going to be 10,000 units, and then each unit is sold at 1,000. At 1,000. So that one will be 10 million, isn't it? So now our sales here is 10,000. It is in millions. Then we less cost of sales or production cost. We less marginal cost of sales or cost of sales. Marginal cost of sales. Marginal cost of sales. So we start with the opening stock. Opening stock. So in this question, we had no opening stock. In some other question, we'll be given the units, the opening stock units. If you're given the opening stock units, how do you value them? You value them based on the marginal cost, marginal production cost per unit. So what is the marginal production cost per unit in this question? So marginal means variable production cost, which constitute material cost per unit. So material cost here, material cost per unit, direct material cost per unit is 360. I hope you can be able to see. So material varies with the volume of production. So that is part of variable cost or marginal cost. We are looking at the production cost only. Material is part of the production cost. And then there is labor. So there is labor cost per unit. Labor cost per unit is 80 shillings. It is 80. Then we have variable production overheads. So they are variable overheads, which are variable per unit. So they are production, not We have variable variable but non-production. Here we're only talking about variable production overheads, which is 60. So 360 plus 80 plus 60 is how much? 500. So in other words, production cost per unit, variable production cost per unit is 500. I want to emphasize here again, when you talk about variable production cost, we are talking about those costs that varies with production, by their production. So these are material costs. Material will vary with production. So the more units you produce, the more cost you incur on material. And then we have labor costs. They also vary with production, isn't it? The more you produce, the more labor, isn't it? And then we have overheads. So these are what we call the production cost. You exclude fixed production cost. So the variable or marginal production cost per unit in this question is 500. So here you multiply 500, you multiply 500, you multiply the number of units that were produced. So opening stock was 0, sorry. If it was there, you will have multiplied it by 500. So this question, it was there. It was not there. So you write there dash. And then you add production cost. Production cost. Production cost, they produced 12,000 units. And then now you value them. You value them based on the variable cost per unit, which is 500. So when you multiply that one, what do you get? 6. So this one will be 6 million or 6,000. And then you less closing stock. So closing stock. So they produced 12,000. They had no opening stock. And then they managed to sell 10,000. So they're retaining how many? 2. So this 2,000, you multiply by 500. How much would that be? 1 million. So you less here 1,000. So this one is how much? 5. So here we call it gross marginal cost, or this is gross marginal profit. Gross marginal profit or gross contribution. So you can write there gross contribution or gross marginal profit or gross contribution. So you can write here gross contribution is the same. So gross contribution. Gross contribution, it will be how much? 5,000. And then you less variable expenses. Variable expenses first. So we have those expenses that are non-production but variable in nature. You give them priority first. So the variable expenses is we have variable selling. Variable selling. Variable selling, we have been told it is 10% of sales. So 10% of 10,000. That one will give you how much? What? 1,000. So we don't have any other variable expenses. If we had more than one, maybe we have variable what? All the variable expenses should come first. And then here we get what we call net contribution. Net contribution or net marginal profit. Net contribution. So how much will that be? So this one is 4,000. And then we less fixed cost or fixed expenses. Fixed cost. We less fixed cost. We less fixed production. Fixed production. So production, fixed production overhead is how much? So we have production overhead here, which is 1980. So we less here 1980. And then we have fixed selling expenses, isn't it? Selling expenses. How much is it? 300. You less 300. And then you less fixed administrative expenses. How much is it? 5. And then here you get the net profit or loss. Net profit stroke loss. How much is it? 12.8. 1220. 1220. like that, isn't it? So that is how we come up with the income statement under marginal costing. Under marginal costing. It's very easy, and it's a very examinable question now and then. Then now we come here and prepare income statement under absorption costing. So we write here X, Y, Z income statement for the months of April, for the month of April 2015, that is absorption costing. Absorption costing. And then here we underline. I think we can have some space here. So we have the sales value. The sales value is how much? So we can have shillings and thousands. We can have shillings and thousands. And shillings and thousands. So we have the sales value. The sales value will remain the same, 10,000 units that were sold at 1,000 per unit. So that will give us 10 million or 10,000. Then now we less cost of sales. We less cost of sales here. We don't less marginal cost of sales, we less here cost of sales. So we start with the opening stock. Now, we had no opening stock units, but supposing they were there, how do you value them? You value them based on the total production cost. So the marginal production cost was 500 per unit. And then we add fixed production cost. So the total fixed production overheads was 1980. So 1980, when you divide by 11,000, how much do you get? 1980,000 divided by 11,000. Eh? 1. So in other words, the total fixed production overheads was 1980. This was meant to be for 11,000 units. So fixed production cost per unit, 180. So you add here 180. So this one, the total production cost will be 680. So now that will be 680. So opening stock was not there. Suppose it was there. You were saying the total production cost per unit is 680, isn't it? So it would have been 680. It is there. Then you add production cost. Production cost. We produce 12,000 units. You multiply them by 680 to convert them into money. What do you get? 91, 81.60. And then we less closing stock. Closing stock was 2,000. You multiply by 680. You value them based on the 680. 1360. So you less here 1360. So you get there. $68, 6,800. Then you get the gross profit here. You get what we call the gross profit. 3,200. So 3,000. So under absorption costing, there is what we call under or over absorption. How does it come? There is what we call over and under absorption. So you check the normal production. The normal. So here we have what we call over stroke under absorption. Over stroke under absorption. So how does over and under absorption come about? You check the normal production per month. Like in this question, the normal production is supposed to be 11,000 units, isn't it? And then now you check the actual production. So the actual production was 12,000. So if the actual production was more than normal, then there is what you call over, isn't it? If the actual is less than the normal, there is what we call under. If there is over, you add back. If there is under, you subtract. So now here we're going to write under stock over. So the normal production was, the actual production was 12,000 minus the normal, which is, and then you multiply by 180 per unit. So they overabsorbed, they overused overhead expenditure by extra 1,000. Nakuja ngapi? 180. So inakuja 180. Nadhani kama tumeelewana hapo. You check the normal production or the production capacity in a given period vis-a-vis the actual. If the actual was more than the normal, that is what you call over absorption. So the difference, you multiply it by the fixed production cost per unit, and then you add back to the profit. Okay? If it is under, you subtract. Then you less, here you less expenses now. You less expenses. So the expenses, we have variable selling. Variable selling. Variable selling was how much? 1,000. So you less 1,000. And then we have fixed selling. Fixed selling, which is 300. You less 300. And then there is administrative fixed admin. Fixed admin expenses, which is 500. And then here you get what we call net profit. Net profit stroke loss. Someone will ask, what about production? Fixed production. It is already absorbed in this 680. It's already absorbed in the 680. So here you don't again consider it separately here. So now that is how we make. Can we get the profit there? 18? So this one will be 1580. So that is how we make. I hope you have seen the differences. The first difference here is that under production cost here it constitutes only the variable production cost. And here is the total cost, that is variable plus fixed. Then valuation of stocks here. We have valued stock based on the variable production cost per unit. Then here some other question will require you to reconcile. So there is what we call the reconciliation statement here. So you can start with the profit as per marginal costing. Profit as per marginal costing, which is 1220. Then here you add adjustment of stock. You come here adjustments of stock. So there is opening stock minus closing stock here. So you start with the opening stock. There is adjustments. Okay, adjustment in stock. So there's adjustment in stock. So here we have marginal, we have marginal minus absorption costing. Here we have absorption. So we have the opening stock. Opening stock under marginal, it was dash. Then you less closing stock here. You less closing stock here. The closing stock under here, it was 1,000. So here it will be minus 1,000 minus, here the closing stock was how much? 1360. So minus 1360. So we have minus 1,000 minus. So it is opening stock minus closing stock. So we have minus 1,000 minus 36. How much do you get? So 360. So you add here 360. So when you add those two, what do you get? So 1580. So you get profit as per absorption costing. Profit as per absorption costing. So that is how we do, that is the income statement part of this particular topic. Any question? So you can, I give you 5 minutes to internalize, and then you tell me, we move on, we do another question. And then you have a question? The reconciliation here is, the difference is about stocks. Okay. Here stock is 1,000. And here stock is? But the other approach I was thinking of is was the difference in the profits as a result of the stocks. Yes, actually the stocks. Yeah, the stocks. Yeah, so you check. One considers variable cost by unit, and the other considers the total cost. So then if we take the change rather than closing stock, and then multiply the variable cost by the fixed cost per unit, we still get the same result. Sure. Yeah, in this case we had 12,000 yeah, 10. 10. Produce the closing, sorry, we take the closing stock, which is 2,000. Closing stock, which is 2,000. Where is the 2,000? 2,000, yes. Yeah, the 2,000. And then we multiply it by the fixed cost by unit, which is 180. That one will give you how much? Yeah, it will give you 360, which is this one. Is it 360? The difference, eh? Which now we have down here. Which you have down here. So it will lead to the same thing, isn't it? Yeah. So basically what is bringing the difference is the stocks. But I think this one is, you can adopt either, but the difference is the stocks, okay? So you can write it, I give you a few minutes to either take a photo, but there's no need for taking a photo because that one has already been highlighted there. Yeah. So we can also do another question. I don't know whether you have it. We can do another question under this particular topic. June 2013, question number 3B. June 2013, question number 3B. June 2013, question number 3B. So here we are doing CPA June 2013, question number 3B. June 2013, question number 3B, CPA. Marginal absorption costing, June 2013, question number 3B. So the question reads, Prograde Limited manufactures a single product. The standard cost per unit as follows: direct materials, 8 shillings, direct labor, 30, variable selling cost, 2. Additional information: the budgeted fixed production overheads per annum amounts to 7,200,000. The normal production level per annum is 2,400,000 units. In the month of April 2013, the number of units produced and sold was 240,000 units and 200,000 units, respectively. And number 4, the fixed selling cost per month amounts to 1.5 million. And the number 5, the selling price per unit is 50 shillings, and there are no opening inventories. Required income statement for the month of April 2013 using absorption costing, marginal costing. I hope you have that question. You have it? Yes. So now here we're going to write Prograde Limited. Prograde Limited income statement for the month of April 2013. April 2013. This is marginal costing. Marginal costing, and then you properly underline. So here we can have shillings and thousands, shillings and thousands, shillings and thousands. So we can here, we identify the sales value. The sales value. So in the month of April, the number of units produced and sold. So they produced 240,000 units and they sold 200,000 units. So this one will be 200,000 units. And then the selling price per unit, the selling price per unit was 50 shillings. So you multiply by 50. So what will be that figure? 10 million. So this one will be 10,000. And then you will less marginal cost of sales. We less marginal cost of sales. Marginal cost of sales, we start with the opening stock. So in this question, we had no opening stock. This question, we had no opening stock. But supposing it was there, how will you have valued it? So we value it based on the marginal production cost per unit. So the marginal production cost per unit constitutes of direct materials and direct labor. It will have been 38. We only have 2 elements, that is material and labor. So it will have been 0. It will have been the number of units, in this case 0 times 38. So now here we write dash. Then we have production cost. Production cost, they produced 240,000 units. So 240,000 units, you multiply 38. What do you get? 240 times 38? 9120. That one will be the production cost. And then you less closing stock. So they produced 240, they sold 200. So they're retaining 40. And then you multiply by 38. So what do you get? 15? 1520. So you subtract this 1520, and then you get the marginal cost of sales there. So 7,600. Then here you get the gross contribution or gross marginal profit. $4,000, $2,000, and then you less variable expenses. You less variable expenses. So the variable expenses, how do you identify the variable expenses? So we've been told variable selling cost is 2 shillings per unit. So it means, So we have variable selling. Variable selling. So the total number of units they incurred, all the units that were sold, they incurred a cost of 2 shillings, the selling cost. So they sold how many units? 200,000, isn't it? You multiply by 2, which is 400. So here you get what we call net contribution. Net contribution. Net contribution. 2. So net contribution will be 2,000. And then you less fixed cost or fixed expenses, fixed cost. So we have fixed production. Fixed production. So the total production cost. So the total budgeted fixed production overheads per annum was 7,200,000. So this 7,200,000 was the production cost for the whole year, isn't it? These are the fixed production costs for the entire year. But we are producing the statement for only 1 month, for the month of April only, isn't it? So we're going to divide this one by 12 so that we can be able to know the one that is for the months of. So here we less 600. And then fixed selling. So we have fixed selling, which is how much? 1,500. Then we get the net profit or you're murmuring. Net loss of 100. So that is how we do it under marginal costing. And then you come here and write Proget Limited. Proget Limited. Income statement for the months. So sales, it will remain the same. Then we less cost of sales. So we have the opening stock. Opening stock, supposing that we had opening stock units, how will you have valued them? Already we have said the marginal production cost is 38 per unit, isn't it? So what is the fixed production cost per unit? So the total fixed production overhead for the whole year was how much? 7,200,000. This was meant to be for how many units? The targeted units, the normal production level is, this was meant to be for 2,400,000 units. This is the total fixed production overheads for the whole year. For how many units? 2,400,000. So what is the cost per unit? 3. Therefore, the total production cost per unit is 41. That is 38, the variable cost, plus 3. So this one you will have multiplied it by 41. It is not there. Then we add production cost. Production cost. So the production, they produce how many units? 240,000 times 41. What do you get? 9840. So we have 9840. And then we less closing stock. Closing stock is they produced 240 units, 240,000 units, they sold 200. So they are retaining how many? 40. The production units minus the sales. So they have 40,000 units. You value them based on the total production cost, which is 41. That one gives you how much? 1640. So you let's say 1640. Eh? It's 200. 8,200. Then here you get the gross profit. You get the gross profit. Eh? So this one will be 1,800. Then here we said we have over, stroke, and absorption. So you write here over, stroke, under absorption. So this will only arise if the normal production is exceeded or not attained. So now here the normal production. So the total units that they are supposed to produce in a year is 2,400,000 units. This is the normal production per year. So when you divide by 12, we get the normal production per month. Remember, we are preparing the statement for 1 month. We're not preparing for the whole year. So we divide this, the total number of units that are supposed to be produced in a year, by 12. Why 12? Because we want to know the production per month. So then will give us how much? 2. So they're supposed to produce the normal production per month is supposed to be 200. But in this month, they produce how many? 240. So they surpass the normal. So here you less 240, okay, 1,000 minus 200,000, and then you multiply by 3. What is 3? 3 is the fixed production cost per unit. So that one gives you how much? One. So when you overproduce, you add. When you underproduce, you subtract. Then you less expenses here. So we have variable selling, variable selling, which is 400. So you less 400 here. And then we have fixed selling. Fixed selling is how much? 1,500. So those are the only expenses. Then you get the net profit here. Those are the only expenses. You get the net profit. What will be the net profit? 20. So in this question, they did not require us to reconcile, but I told you, you need to know how to reconcile, isn't it? So you can write here reconciliation statement. So you can start with the profit as per marginal costing, 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 which is negative 100. Then we have adjustment in stocks, adjustments in stocks. So we have marginal minus absorption. So we have the opening stock, which is 0, 0. You less closing stock. Closing stock is how much? 1520. And the other one is 16. Is it 1640? So this one will be minus 1520 minus 1640. So what do you get? What do you get? 120. So you get 120 here. And then you get here what we call profit as per absorption costing, which is 20. That is how we do those questions. So you can internalize it. You take 2 minutes before we look at other things under the topic. under marginal and absorption costing. So we have several questions. We have several questions under that topic for your exercise. Like, for example, we have April 2011, I think so. Is it May 2011, if I'm not wrong? We have May 2011. So there's that question of December 2005. I've done it there. I've written the question, the notes, you can as well review it. And then we have, which one, other one? So, is it August 2009? Can you check August 2009? So question to attempt under this particular topic. The first question to attempt is question to attempt. So November 2011 question number, November 2011 question number. Is it May or November? Just a minute. I think it's May 2011 question number 4. May 2011 question number 4. So May assignment, we have May 2011. May 2011 question number 4. That is number 1. Then we have August 2009. May 2011 question number 4. You write it down. August 2009 question number. August 2009 question number 1. August 2009. August 2009 question number 1. And then another one. That is August 2009 question number 1. Then let us check recently. Let's check recently whether we have such a question. So you can also check December 2021, question number 3. DEC 2021, DEC 2021, question number 3. So those are the questions you can do. DEC 2021, question number 3. Part of this topic, we call it CVP analysis. CVP analysis or break-even analysis. So application of marginal costing, and we want to look at what we call the CVP analysis. So there's what we call the CVP analysis. CVP analysis or break-even analysis. So break-even analysis, sometimes we call it break-even analysis. CVP analysis stroke break-even analysis. CVP stands for cost volume profit analysis. Cost volume profit analysis. So when you check those notes, we go back to the notes. So this is also known as break-even analysis. At break-even point, total cost is equivalent to total revenue. At break-even point is where total cost is equal to total revenue. So the company is neither making profit nor losses. Revenue and costs are the same. That is what you call the break-even point. So you want to analyze when you're starting a business, at what point will you not be generating losses or profit? So you're not incurring any loss or profit. So it's a technique which is used by the management to study the behavior of the profit in response to changes in volume, selling price, and total cost. So cost, volume, and price. So you want to see, what if I change the cost? What will be the impact on my profit? What if I change the volume? What will be the impact? What if I change the price? What will be the impact? That is why we call CVP, cost, volume, profit. So you also need to know the assumption. This is a very common question in exams. Assumptions is the same as the limitation of the CVP analysis. So in CVP analysis, they assume that all the costs are either fixed or variable. So the costs are either divided into fixed or variable. ICE and variable costs are not included. So we all know it's not possible that all the costs will be just fixed and variable. And number two, they assume that all units produced are sold. That is another assumption of CVP. Number four, they assume that the volume is known in advance and it's assumed to be the only factor affecting profit. We know the other factors affecting profit, but the CVP, that is the assumption. Then they say the selling price remain constant at all levels of sales. That is another assumption. So there are those assumptions you need to know. NB, for limitation of CVP analysis, entices there, you just explain the assumptions, those assumptions. For example, they assume that all units produced are sold, isn't it? It is not practical that you sell all the units that you produce, isn't it? In reality, you can't sell all the units that you produce. So now CVP can be analyzed graphically using two models. We have what we call the accountant model, and we have the economist model. So the accountant model, take this shape. So we have the fixed cost here. And then, so these are cost and revenue. These are cost stroke revenue, and these are units. So this is revenue, and maybe this is total revenue. This is cost. This is TR, total revenue. This is total cost. So this is profit, and this is loss. So the point where total cost and total revenue meets, that is where break-even analysis, that point. So these are the units. The more units you sell and they produce and sell, the more the total cost and the more the total revenue. But there's a point where they meet. So that point is called the break-even point. So if you operate above this point, you are making profit. If you operate below this point, you are making losses. So that is the accountant model, BEP. And then we have the economist model. The economist model argues that we have two break-even points. We have two break-even points. So it goes like this, and then it goes like this. So this is a total revenue, total cost. So we have two break-even points here, BEP1, and then here we have another one, BEP2. That is the economist model. So when you're starting operations, you're starting a new business or a new company with heavy capital, there are no competition. People are very active and very motivated. So you'll find that the revenue are rising at that point, isn't it? You still have new machine, new employees. They are very, very motivated. They are coming to work very early. They're doing everything right. You have new vibrant staff, and you don't have competition in the market, and your machine are still very good. Then with the time, machines grows old. We have competition, isn't it? The employees are no longer very motivated, and then now the total costs start rising and the total revenue start falling, isn't it? So we have these 2 points. So the total revenue again will meet when the revenue is going down and costs are going up at some point. You see, when the business has grown too much, it starts coming down. We have seen it in Kenya, isn't it? We've had companies like Tuskys, Nakumatt, when they were at their peak, they went down, isn't it? So those are the factors. So that is how we analyze it. So maybe you go and do research on break-even charts. What are the advantages of break-even charts? I have seen that kind of question. So you go and research on that. You research on that. Now, when it comes to variables and other initials that assist us to analyze break-even point, we have the initials. For example, the initial that you're supposed to know. P stands for selling price per unit. Selling price per unit, P. And V stands for variable cost per unit, variable cost per unit. And F stands for fixed cost. Fixed cost. F stands for fixed cost. And then we have CM stands for contribution margin. Contribution margin. CMR stands for contribution margin ratio. Contribution margin ratio. VCR stands for variable cost ratio. Variable cost ratio. Variable cost ratio. Variable cost ratio. And then we have XT stands for target profit. Target profit. RT stands for target revenue. Target revenue. And then VCR plus CMR is equals to 1. VCR plus CMR is equals to 1. And then we have MOS stands for margin of safety. Margin of safety. MOS stands for margin of safety. Margin of safety. So those are the things that you're supposed to know. BEP stands for break-even point. BEP stands for break-even point. So those are the initials to help us understand this CVP analysis. Now, there are the equations that you need to know. So we have 4 equations that you need to know under CVP analysis. So equations here. There are equations that you need to know under CVP analysis. So we have equations in units. We have equations in unit, and the first equation is the profit. Profit is the initial for profit is pi. Profit is equals to P minus V, and then you multiply by X. I had forgotten here. X stands for units produced and sold. Units produced and sold. So minus F. So P minus V is the same as contribution margin. So contribution margin, you multiply by the units produced and sold, you minus fixed cost, you get the profit. So every time the question asks you about the profit, this formula must come into your mind. That is number 1. Then number 2 is what we call XBP. The number of units that you must be able to produce and sell in order to break even. So that one is equals to fixed cost over contribution margin. Contribution margin, you are saying it is P, selling price per unit, minus variable cost per unit. That is the XBP. Then number 3 is XT. You are targeting a particular profit. So you want to know the number of units that you must sell in order to attain that particular profit. There's a profit in mind that you have. So you want to know the number of units that you must sell in order to attain that particular profit. So that one is equals to F plus the T that you're targeting over CM. Then number 4, we have what we call the margin of safety. What is margin of safety? This is the sales units below which the sales should not fall. The units below which the sales should not fall. Otherwise, you begin generating losses. The level below which sales should not fall. Otherwise, the company begins. So these are budgeted sales minus break-even sales. These are in units. So this is equation. There are 4 questions. They're very, very important as far as CVP is concerned. And then we have the same under now shillings. These are in units. Now under money. So the first one is what we call, number 1 is the profit. So the profit here is contribution margin ratio. You multiply by selling revenue. Is it, do you multiply by R minus fixed cost? You multiply by, is it R? You multiply by, yeah, I think revenue, multiply by revenue. Multiply, just a confirmation. No, you multiply by revenue. CMR you multiply by F, then you minus. So CMR we say it is the contribution margin ratio, which is P minus V over P. How do you get the CMR? You take the selling price per unit, you deduct variable cost per unit over the selling price per unit. Then number 3, we have what we call XRBP. So break even in shillings. This was break even in units. So break even in shillings is the fixed cost over CMR. Fixed cost over CMR. Then we have RT. The revenue that you are targeting a particular profit. So you want to know how much you must sell in terms of sales revenue, in terms of money, in order to attain that particular profit. So it will be F plus T over CMR. CMR is the contribution margin ratio. And then number 3 is, that is number 1, 2, 3. This is 1, 2, 3. So this is number 3. Number 4 here, we have a margin of safety. Of course, it's a budgeted sales in shillings now. Budgeted sales in shillings minus break-even, revenue break-even, RBP, break-even in shillings. And lastly, we have what we call VCR, variable cost ratio. Variable cost ratio is equal to V over P. So VCR plus CMR is equals to 1. Once you know those things that are written there, you are now safe as far as that particular area is concerned. So now let us look at question. Let us look at question. Let us look at question. So we can go to the other past papers, the old one. We can start with the so we go to that question. That is old papers, June 2010, I think. June 20, we go to that question paper, June 2010. We check June 2010 question number. We go to that past paper, June 2010, June 2010, June 2010, June 2010. It's not June 2010, sorry. It's supposed to be December 2010. November 2010, question number 4. So November 2010, question number 4. So we are looking at break-even analysis, CVP analysis. CPA, November 2010. November 2010, question number 4A. So, but before that, describe the differences between the accountant and the economist model of cost volume profit analysis, and then highlight 6 limitations of cost volume profit analysis, that is 6 marks, 10 marks. And then Leisure Enterprises is in the process of determining the viability of a concert in Nairobi. So the following information shows the estimated cost for the concert. Estimated fixed cost is 600,000 shillings per ticket. The proposed price for the sale of the ticket is 200 shillings, and the expected sales are 8,000 tickets. The number of tickets required, the number of tickets that will be sold to break even. And then number 2, the number of tickets that must be sold to earn a target profit of 1,000. And number 3, the profit that will be realized if 8 tickets were sold. And then number 4 is if the selling price to be charged to earn a profit of 300,000 on sale of 8,000 tickets, fixed cost of 600,000 and variable cost of 100 shillings per ticket. Then number 4, percentage of margin of safety. So the total marks in that question is 20 marks. So we all have those information. So we start with number 1. We start with number 1. Number 1, the question wants us to determine the break-even in units. Number of XBP. So the question wants us to determine XBP. So the first thing is you write the formula for the requirement. So the XBP said is F over CM. CM is a contribution margin. So once you've written the formula, you identify those variables in the question, whether you have them. For example, F, we have it. F is equals to 600,000. Have you seen it? For us to contribute the contribution margin, we need price and variable cost. So the P, which is the selling price per unit, is there in the question. It is 200. And the variable cost per unit, which is V, is 100. So we have all the ingredients. Now we come here and do our question. 600,000 over 200 minus 100. So what do you get? Huh? So they must sell 6,000 tickets. They must sell 6,000 tickets to break even. So they must sell 6,000 tickets to break even. That was the first requirement. Then Roman number 2, they wanted us to determine the number of tickets that must be sold to earn a target profit of 300. So that is XT. So the number of tickets, that is sales units, that must be in order to, so F plus T, they want F plus T over CM. So F is 600,000. Our target profit is 300,000. Our CM is 100. In other words, 200 minus 100. So how much do you get? So they must sell 9,000 tickets. They must sell 9,000 tickets in order to get a profit of 3. Number 3. And then the profit that will be realized if 8,006 tickets were sold. So once you hear the word profit, you write down the formula for profit. For profit, we said F, profit is this, it's denoted by pi, which is P minus V, and then you multiply by X, and then you minus fixed cost. That is the formula for profit. So our P is 200,000, our V is 100,000, Bob, and then if they are selling 8,000 tickets, and the fixed cost being 600,000. So what will be the profit? So what will be the profit? 400,000. 200,000. So in other words, if they sell 8,000 tickets and the selling price at 200, variable cost per unit 100, fixed cost being 600, the profit to be realized how much? 200,000. And then the profit that will be realized, so that one we are through it. And then number 4, Roman number 4, they're asking what are they asking? They're asking the price to be sold. So they ask, so it is the profit still. Profit is going to be P minus V. You multiply by X minus F. So they're asking, what will be the profit? What will be the selling price? If the profit earned is how much? If the profit is 300,000 and the selling price, we don't know the selling price, the variable cost remains 100. The variable cost remains 100 and the number of units sold is 8,000 and the fixed cost be 6,000, isn't it? 600,000, isn't it? So they're asking what will be the price, selling price, if the profit, the number of units sold is 8,000 and the fixed cost is 600,000 and the profit is 3. So we open the bracket here. So it will be 8,000 P minus 8,000. This is 800,000 minus 600,000 is equals to 3. So these two, 800,000 will cross the other side and becomes positive. So 800,000 plus 300,000, that will be, so it will be 1 million, 1,700,000. Is it so? Is equals to 8,000 P. Then I will divide 8,000 by both sides. So the selling price will be how much? $212.5. Then lastly, we're asking for the margin of safety in percentage. So that is budgeted sales minus BEP sales. BEP. So they budgeted to sell 8,000 units. That is the budgeted, that is estimated sales, 8,000, and the break-even is 6,000. So 6,000 over 8,000. What do you get? Times 100, of course, because they want it in percentage. 25? So this is 25%. So 8,000 was the budgeted sales, and the break-even sales was 6,000. So over this. So that was done in November 2010, question number. So can you write it down before we do another? So there are several questions of that kind. So we can go to June 2013. June 2013 question number 3A. 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 So the entire question was under marginal costing, that question. So this sitting had two questions, under marginal and absorption costing. So the question is question 3A, June 2013 question number 3A. The question reads, Agnes Caseo and Peter Power decided to venture into the same business in the year 2012. So they sell the same type of product in the same type of market. So they have provided the following budgeted income statement for the year ending 30th June 2014. So we have the sales, variable costs, and fixed costs, budgeted profit there. So the required break-even point of each business. So they want us to break even. So now where the question has not given you the number of units that were involved, they haven't given you the number of units. So you take the entire sales to be your P. Okay, and then that variable cost to be your V. So don't look for units when they have not given you the units. And then when they have not given you the units and they're asking for variable, the break-even point, you only compute the break-even point in money, in monetary form, isn't it? This one is, we don't have units here. We've only been given sales in money form, variable cost in money form, fixed cost in money form. So we don't have the units. So don't struggle to, that is the one break-even point in money. So right here, RBP. We don't have the units, so don't struggle to find the units. So here it is fixed cost over contribution margin ratio. So here we have the fixed cost already, so we come here and compute what you call the contribution margin ratio, which is said it is P minus V over P. So our P, we are saying it is the entire, so we have Agnes. We have the business of Agnes. So Agnes, the total sales value is going to be, P is going to be the total sales, which is 600 million over the variable cost is minus, variable cost is 480 million over 600 million. So that one will be the variable cost. What do you get? And then we have Power, Peter. Peter, we have 600 million minus variable cost per unit is 400. So how much do you get? This one is 0.2. And the other one? 0.33. So that is the contribution margin. Therefore, BEP, break-even point. So we have Peter here. So we have Agnes. And we have Peter. So the fixed cost for under Peter is 60 million. So 60 million over 0.2. So you get the break even. And the other one, the fixed cost is 140 million over 0.33. So the first one, what do you get? Shillings 300 million. And the other one? For shillings, 4,400,000. Huh? 424 for 40. 424, 42, 242, 424. So it's like that, but you understand what you're doing, isn't it? So that one will earn you how many marks? 2 marks. Very easy to get marks. And then the sales volume at which the business will earn a profit of 20 million. So they're asking for XT or RT, which is going to be F plus T over CMR. So here we have Agnes. Agnes, the fixed cost is, so we can write here 60,000, just as a plus, the target is 20,000 over the CMR is 0.2. And then this other guy, Peter, is going to be, the fixed cost is 140,000 plus the target, which is 20,000 over 0.33. So that one will earn you 8 marks. Very easy marks to get. Very, very easy marks. How much you get? Huh? 400,000 for Agnes. And the other one? $408.48. So that was done in June 2013. So we have said many questions of this kind. Many questions of this kind. There is also another aspect of CVP which we'll be doing next time. But in the meantime, let me give you some assignment on the same. So you can, May 2014, is it May 2014? Attempt May 2014. Is it May or December? So it is December 2014, question number 4B. So attempt, assignment here on CVP. Assignment on CVP. December 2014, DEC 2014, question number 4B. Question number 4B. So you attempt that one, and then we shall do more other question next week. We shall do more other question next week, and perhaps look review other questions under the same. We'll also be looking at CVP when you have more than one product. So we'll be looking at that. Then, if time allows, we'll also look at. So we'll be looking at multi-products, CVP under multi-products, and non-routine decisions on Friday. So that one will be the end of our class today.